Welcome to the Real Property Investments Lunchtime Wealth Webinar Series, where you can join us every Thursday at 12 p.m. Eastern Standard Time for a free 60-minute Lunchtime Wealth Webinar, featuring different guest speaker every week. My name is Monica Jazik. I'm a real estate investment specialist and wealth builder and owner of Real Property Investments, where we help real people build real wealth through real estate and alternative investments. We've helped over 800 people achieve freedom in their lives by building wealth, and our goal is to empower as many people as possible to take action and start doing things differently in regards to your wealth building, so you can live and be able to afford your absolute best life. On today's Lunchtime Wealth Webinar, we're talking to private money lender Susan Flanagan. Susan's an investor as well as a private lender and owner of Private Money for Mortgages. Today she'll be sharing the real truth about investing in private mortgages. Welcome, Susan, and thank you so much for joining us today.
Thank you for having me.
It's always a pleasure to have amazing guest speakers like yourself talking about some really amazing investment opportunities like private mortgages. I think it's something that most people are really kind of familiar with. And, you know, it's probably a topic that a lot of people want to get involved in, but you're always a bit sketchy on, like, how do we know we're doing it the right way? So we're really excited to have you here today to tell us the real truth about private mortgages. So this is like the good, the bad, and the ugly. How can investors like me grow my money with people like you?
Okay.
That's what we want to talk about today. So anyone who's logging in, thanks everyone for logging in. You guys can answer your, ask any questions in this Q&A box or the chat box. I will be checking throughout the webinar, and this is your chance to really get up close and personal with Sue, and she will be answering your questions in real time if you have any. So Sue, we start off by you giving a bit of a background about yourself, how you got into this, and why you're so passionate about these private mortgages? Because whenever I see you, your eyes light up like it's Christmas when you talk about private mortgages.
Okay, well, I'll first off explain that I am first and foremost a real estate investor. I have been investing in real estate for over 30 years. Along the way, I started lending my own money in mortgages. That was about 12 years ago. And so I was, buying properties, being a landlord, doing all of that from a real estate perspective, but also putting my RSP monies to work in mortgages. Mm-hmm. Now, the reason that even started, which is interesting, I had just RSPs with mutual funds, as most people do, and you don't even think twice of what they're in, I'll bet. Because I didn't either. I was like, oh, yeah, okay. I have stuff in RSPs is how I looked at it.
You kind of set it and forget it.
Yeah. And so then all of a sudden you go back to the year 2000. And now when I look back and go, boy, was that ever a marketing ploy by the financial world that mm-hmm. they painting doom and gloom, be careful with your investments, all this stuff's going to happen. And so somebody approached me with the idea of, I can put you into RSPs that, don't worry, you won't lose money if anything happens with the market. And so I bought into that. I mean, I was wrong in the sense that I didn't do enough due diligence. I know that now. But at the time went, oh, okay, sure, if this is going to be helpful. So I get into this segregated fund with my RSPs, yeah. And then all of a sudden, my portfolio started going down and down and down by about 206. So you imagine I got into it at just before 2000. By 206, my $111,000 portfolio was down to about 40,000. I am beside myself. Of course, I'm on the phone to the so-called financial planner, and he's saying, well, don't worry. I mean, you'll never lose money. I told you this is a plan that you stick with. But I didn't realize I had to stay with it for 10 years. It was like, that is when I was like livid. But the best news about my story is that it motivated me to go, this sucks. I will never trust anybody again with my hard-earned money. I will put it to work in something I'm comfortable with. And I started researching through real estate because I was already an investor of buying properties and being a landlord and so forth. And that's when I first heard about lending your money in mortgages. And you could do it with registered funds. And I thought, what? So I researched it more. And needless to say, I stepped into that. But the sad thing about my story was that for 10 years, my money, I mean, I did have to wait till the year 2000 to get it out. If I had taken it sooner, I would have taken the value that it was marked at. And so I put 111,000 in and I got 111,000 back. I actually went backwards with my investments.
You know, that's so frustrating. And that story really resonates with me because I always go back to our story with Vaughn and I. Our first, when we got into investing, or young adults, weren't even 30 yet. And we're trying to do things the right way. And we met with our investment planner, advisor with Sun Life or wherever they're from. And they give you this advice. And it really is a set it or forget it. And then you never hear from them.
Yes.
And till we finally, one day, 2008 came. And I looked at our projected returns. I looked at our how much money we lost, first of all.
Yeah.
And our projected returns were, if we were lucky and kept doing what we're doing, we would have $40,000 by the time we're retired, which really didn't make any sense. And I thought, oh my gosh, like, we're trying to fund kids' educations here. We had our, our ESPs, we had our retirement. We're trying to get freedom in our lives. We're doing things the way the so-called government says that we're supposed to do it. But it's not working, and there has to be a better way. So you wanted a better way.
Yeah. So I mean,
investing in mortgages. Was it easy from the start?
Not at all.
Have you had any horror stories?
Okay, it was not easy, and I'll tell you why. It was not easy only because going back 12 years ago, I didn't have anybody to show me how to do it. I just knew I could go through it. I had to go through a trust company at the time. TD was one that you could use. It was a nightmare getting it all set up because I didn't know what to do. And there wasn't a lot of people that I knew to ask. Because as it is right now, and I'm sure there's people listening right now, that this might be the first time that you're hearing about lending money in private mortgages. And you're going, what? I didn't know I could do that. And I'll tell you the reason why, because I get this question all the time. If it's such a good deal, why haven't I heard about it before? Right? And I'll tell you why you haven't. Number one, your bank is not going to tell you about it. They want your money, whether you realize it or not, they want your money sitting in this really low interest account so that they can use your money and put it out there and make great investments.
They're investing in private mortgages.
Yeah. Why do you think they're making billions of dollars? So they're not going to tell you about it. Second off, your financial planner, they're not going to tell you because they don't make a profit from this. They only make a profit when they put you into mutual funds or stocks. And that's the thing. I hate to say this if there's any investors listening, but are not investors, I mean financial planners listening, or financial advisors, whatever name you want to call yourself. I'm sorry, but I believe you're basically a salesperson for the product that you are advertising.
They're limited. They're limited what they can do.
And it's not your fault, their fault, but the reality as consumers, we need to know the truth. So that is the truth that now all of a sudden I'm presenting today, saying, hey, there's a better way. You could invest directly in a mortgage. And it's the best kept secret going. So I mean, it boils down to that you actually are going to be the bank. And I'm flipping along. Well, here's a slide I've put up here. Knowledge is the key to success. And it truly is. Actually, even going back, this I love, by Warren Buffett. I'm sure people have heard it before. If you don't find a way to make money while you sleep, you will work till you die.
I love this quote.
Oh,
now, as a wealth builder, this quote resonates with me very, very good, because I always ask people, and we have a lot of people who have great money and great paying jobs, how much are you worth right now if you stop working?
Yes.
And that's what people really need to work. And when I do my presentations and I talk about how, you should be making money when you sleep, and it's getting your money working for you, not you working for your money.
Yeah.
For sure. And I remember saying that in a classroom presentation. And right now I'm here volunteering, but I'm making money. And I remember the glares from the teachers in the back of the room, like,
Well, but I mean, there's nothing wrong with having a job. And we know where that fits in, and that's great. But at the same time, if we understand the concept that money, why do you think, I say to myself, how do the rich keep getting richer? Because they understand how money works for us.
Yeah.
And there's nothing to say we can't do the same, whether you have $30,000 to start, 50,000, 100, but we make our money work. So basically with private money or private mortgages, to put it in perspective, it's nothing more than a loan. That's what it is. And it's a loan with collateral, right? And it's an actual piece of real estate. And what it boils down to, when I put my money out for a private mortgage, I've become the bank. I'm the one that there's a registered charge on that property. And if you pulled title, it would say the mortgage holder is Susan Flanagan.
Okay.
Okay, so that's the thing that when people go, oh, it could be risky. Is it? I'm going to, hopefully by the time we finish the presentation and our discussion, people will understand, of course, any investment has risk. But when I weigh out the risk of lending money on an asset of something brick and mortar, I don't know. I don't see, I'm not near as concerned as if I turned around and put it into a stock. I mean, or mutual funds. I mean, when you say the word mutual funds, do people truly understand what that means? It's a bunch of stocks.
That we have no control over, that's being dispersed.
Yeah. Yeah, I mean, if you were paying attention right now to the news, what's going on with the States and China with a possible trade war happening, do you not think that's going to impact the stock market big time? And here's your money sitting there and you have no control over it. That's my personal argument on a regular basis.
Yeah, and with Donald Trump on Twitter, I mean, whoa.
Yeah.
We have no control over the stock market. But I have a question for you here, because you mentioned it's risk, and I agree with you. Everything has risk. Every investment has risk. Getting out of bed in the morning is a risk.
Yeah.
But I love private mortgage lending, and I love the fact that we could do it through you. But I'm going to give you a bit of a challenge here. On the other side of the coin, it is risky if you do it with just anyone. Now, this is why at Real Property Investments, we teach people to mitigate risk through education and empowerment. Learning their numbers, learning how to vet opportunities. We could teach you how to do it on your own, go out and buy the real estate, do whatever. But even if you're not actively buying real estate or, doing a development or, doing any of these things, we also teach you how to mitigate your risk by understanding the risk factors and knowing how to calculate a good deal from a bad deal. So take a long story short, we've been behind the scenes of a lot of different properties, a lot of different types of investments. We used to be very active investors. And I've been at a lot of properties that were not being shown to me by the real estate agents. Guess who was showing me the property? The new owner, which is this person who was holding the private mortgage. I remember we were at a 5-plex in Meaford, and he was shaking his head saying, I never thought, I haven't even seen this property before. I'm the lender on it. It went off, and it ended up in my hands now. And now I'm stuck with this thing and I'm trying to sell it and show it. And God, this is a total nightmare. Where can you see what went wrong in a situation like that? How can us private lenders avoid that in something that's going to end up where, oh my gosh, all of a sudden it's our responsibility and we have to get this property sold?
Okay. First off, my first suggestion to anybody who has never done private lending yet, why on earth would you lend, and I'll use you, Monica, as an example. John Doe comes to you and says, I need a mortgage. Would you be willing to lend to me and I'll pay you 15%? First thing you're seeing probably is going, your eyes are lighting up, 15%. You're doing your calculations. You're all excited. But if you've never done private lending, you would have been doing, who are you going to learn from? of the risks and everything from the borrower. You think they're going to explain everything to you that could go wrong? No, they just want to borrow your money. And I honestly, I see this all the time, right? Because I mean, I'm out there networking and meeting investors all the time, and I am finding that there are people that they're lending to, you know, their buddy, and they go, "Oh, that's okay, I trust him." And I'm looking at them thinking, this isn't a matter of trusting a person, because I would trust you, Monica, to the bitter end. However, if I didn't do my proper due diligence on the entire deal, I'm the one that's an idiot, and it had nothing to do with you. And you may have even, oh, sorry, I'm now saying you're the borrower. You were the lender, but the person borrowing the money, all they want to do is get a loan. They don't even sometimes recognize all the pitfalls that can happen. And then if this scenario goes south,
it's a very stressful situation, and I've seen it happen.
And it's not needed. So that's why what I say to people, if you're in the beginning to learn about this, to get educated, do it through, and I'll say somebody like me, because what I didn't get in, carry on to say at the beginning there, yes, I've been lending my own money, but as time moved on, that's when I eventually went and got my license, because I did some good marketing in the beginning, and I had way more people coming to me needing mortgages than I could fund. And I started connecting people, and technically now that's brokering. So I went and got my license. So now I am in a position that if a lender wants to put money out there, I can connect them with the borrower, and this is all I do.
And I think that's a much safer strategy than two friends who are kind of learning, and you don't want to learn on like someone else's dime really, or someone else learning on your dime really. And I think that's kind of what's gone wrong. The reason why it took us so long, because we do a lot of self-directing and private market investing, and we are all about self-directing your registered funds, your cash. And this really, private lending is one of those things that can really give you that, replace your job cash flow as well. It could be either used for long term or it could be used for short term. And we procrastinate. I have a lot of investors coming, my mortgage agent is saying this, or I have this, or I met some Joe Blow at some meetup group and they have this opportunity. And I have said, use a licensed professional who's personally done this themselves. And by doing, this is all you do, right, Sue?
Yeah, and I purposely did that because I thought, I mean, if you're too many things to too many people, you can't be a real specific go-to person. So I want to be the go-to person for people in private lending, because I feel what I bring to the table is A, I've been a lender for many years, and B, I've also borrowed money in the private space for many years. So I get it from both sides, and I understand both sides. But I've also now, when you're talking about the risks, I mean, I am going back in the beginning. I learned by lending my money to a borrower. I never had anything go bad, but when I look back, it makes me cringe. I was in numerous situations that it could have, but I didn't even know I was in something that could have gone south. Right. Because I didn't have enough knowledge behind me. So the things that I know today and I'm able to share with people and help them through is because I've learned it along the way. And I mean, I'll be honest, like any mortgage broker could, put you into a private mortgage easily. But that doesn't mean that they understand all the background either if they've never done it.
So what are some things that, like, rules that you learn along the way? Because the reason we trust you to invest money privately too is because you are behind every deal mitigating that risk. And you explain the deal to the investor. So let's pretend I came to you and I'm like, Sue, what's my minimum investment I need? $50,000?
Well, you know what? It was $50,000, but I have way too many lenders now with low amounts. I have had to up my amount. So if anybody new wants to come on board as a lender, it has to be minimum 100.
Okay.
I just have to do that because there are times I can put 2 or 3 lenders into one mortgage, but I can't do that on a regular basis. And we're getting higher amounts of mortgages that are needed now. So yes, my minimum to come to me would be 100,000. So, so yeah, to walk you through that, I mean, here, I'm just going to flip. There's another slide I just put up here to do with risks. And the main thing, when I'm looking at like I've got my list of lenders, and when I have a mortgage, somebody call me for a mortgage, I'm vetting it long before I present it to a lender. In fact, people have no idea how many that I've turned down that I would not present to my lenders, because there's a few key things that I look for on your behalf if you're the lender. So number one, the location. I mean, it has to be, I'm not saying a certain town or area, but it has to be marketable.
What if I wanted to invest in Timbuktu?
Well, unless it's, and again, I use the term marketable, because it could be, but now, as I say that doesn't mean I won't lend in Timbuktu, but see, it's almost like you look at a checklist, okay? Marketable is a big one. Another big one would be loan to value. Okay, loan to value, for people who don't understand it, would mean, let's say if a property was worth 100,000, I would only lend you up to 80% of that amount.
So no money down deals, Sue?
Oh gosh, no.
And years?
Yeah, and that's so funny you say that, because I have many borrowers call and say, I'm looking for, well, I need the whole thing financed. And I'm thinking, well, I'm not saying you can't do that, but you won't do it through me. So I would lend, let's use the first mortgage as an example there. I would lend them the 80% on the first. Now, in all reality, I don't really care where they get their down payment, because think of it, if something went wrong and they could not pay or did not pay, as long as we can get our money out, that's our only concern, right? So that's where that 80% is that magical number. In most cases, it's enough and sorry, I'm kind of jumping ahead, but just to explain to people, the worst case scenario, if somebody didn't pay, the leverage you have as a lender is the minimum you need is 2 weeks. The average person doesn't know this, because the banks would take maybe 2 or 3 months before they would, put you into power of sale. But as a private lender, if you didn't pay me within 2 weeks, technically, I could start that process right then to get my money out.
Isn't that called like silent possession or something?
No, I mean, it's just, well, see, you can, oh, you're laughing. You could turn around ultimately and take possession, but what your goal is to get your money out, and all it boils down to is the lawyer starts off with sending a letter. Then they would, if they're not getting any, satisfaction with being nice about it, then it turns around that the house is put up for sale through a real estate agent. It's that simple. And once it sells, then you get your money. If there's anything left over, then the owner gets theirs.
So the 20% is like a nice cushion, basically. Yes. You're able to sell it quickly and fast at a reduced price. And I remember that when we borrowed money a long time ago. And it was called, and I remember reading that silent possession in the form of, basically it's like, you don't pay in this time. They could literally just immediately start the seeds. It's not like a letter, like you might get that letter, you've missed a payment, but there have been things behind the scenes happening before that letter is even received by you. And in
most cases, I'll be honest, I've never been involved with a power sale. I have no intention of wanting to be involved. Bottom line, and I say this to borrowers, I say it to lenders as they're coming on board. Bottom line, if somebody truly, their situation changed and they cannot pay it back, the first thing I would say to them is, don't be silly. Just sell your property. Don't make us have to push it on you, because now you've got legal costs. So I don't want to, the collateral is the property. It's pretty easy, pretty simple, so to do that. But things that can impact it, and that's why this slide, I like to point to it. Like, so for instance, the main risk is any risk associated with the borrower's ability to repay the mortgage. That's what we were just talking about. Another risk could be that if somebody didn't have it properly insured. So as a lender, how many lenders are making sure that that somebody's staying up on their property insurance? If somebody was in property tax arrears, all that could impact it. If the market drops significantly, and of course, you were selling at a time that it bottomed out, you could, the money you get out could be less. But that's why the loan to value is critical. That's why I would not lend at 95% loan to value or even 90%.
Have you ever done 100% loaning? You loan out the 80 and they secure, have you ever secured it against anyone's personal residence?
Yes, quite often. So what would happen there, and again, when I'm saying there's a whole thing of check boxes, more or less, that I'm looking at with the property. Like, for instance, their ability to pay back the loan. There's a simple one. Well, now all of a sudden, if they're an investor that their money's all tied up and it on paper doesn't look like they could pay it back easily, we'll do things like include another property, cross-collateralize with another property, or make it in the loan that they pay their payments up front. Like, there's many ways that this can get put together so that the borrower gets what they need and the lender is happy because they have a secure situation. That's all I'm trying to do for people. But when you're saying using another property, that's only if I don't feel there's enough security in it. Or the lender can be pushing for that, saying, no, I'd feel comfortable if they also put a charge against their personal property as well as this rental. Yeah, that's, I mean, we're making the rules. The banks don't make them.
That's the great thing about private lending. We can make some of the rules. And I think that's only also in issues where you might be renovating a property too, or flipping a property. Like, okay, so this is great. You know, they're putting, or if you want to put you want to put no money down. Okay, well, I'm going to take an extra out on your personal residence as well.
Well, I would never, like, as one mortgage, I could tell you right now, I would never suggest anyone to do 100% against a property. That person has to have some skin in the game. Now, when I say that skin in the game, it could be that they've turned around and maybe gotten, for the down payment, they could have gone to somebody else, like a family member, and asked them to give them a second mortgage against the property and use the personal residence as added collateral. That's where it could come in. But for one person to do the total 100%, I would never recommend that all day long.
Right. And we're not about that. And I think it's a lot better. It's a lot assuring, knowing, because a lot of people, some lenders will do 100% financing and they will do it at an extra rate. And it's really not probably for the best interest of the investor, for sure. And
for either one.
This last one here, for lack of quick liquidity. It's like, okay, so the property just might not sell when we need to sell it. The market's turned and then they're not going to, you might have to wait. How do you handle that if someone is supposed to get their money back?
That's a good point. So, I mean, for instance, we're painting the worst case scenario, which it rarely happens to have all those things happen. But let's just say the market took a downturn. And this person can't pay, and the lender is like, I want my money right now. So what can happen at that point? Of course, there's things written into the commitment that if it were rented, the rents now go to the lender. Or let's say it was a personal, it was a residence that they'd have to rent it out until they can sell it. But as a risk to the lender, you have to know, even though these are short-term loans, they're a year or less. That's how they're always set up. You have to be aware as a risk that if they weren't able to pay me, am I okay with waiting for my payments? Because it could be that they can't pay, and then by the time we sell it, it doesn't mean you're going to lose that money. It's going to come off at the end. When the house closes, all those late payments would have been paid out. There'd be a default charge. There'd be all these extra charges that you'll get, but you might have to wait. So it's not like a GIC where you can just go in and say, well, I just want to close it out now. So as a lender, people have to think about that. Am I okay if I can't get my money throughout this next year?
Yeah. No, that's good, and that's a good way to think of it too. A lot of people think it's just so liquid, and real estate is not liquid. It's one of the downfalls. Now, my last question for you about this, and it's not a risk of private lending, but let's pretend I have $100,000 I want to give to you for private lending. Isn't another risk to be a lot of people collect the money And then there's no deal to fund. So my money literally is making zero while I'm waiting.
No. Okay, with that, I never touch anybody's money. I have zero access to your money. What I'm doing, so what happens, let's just say I found this mortgage. I've given you all the details. You and I have chatted about it. I've given you all the scenario about it. You've answered all your questions. And you go, yes, I'm ready to do this. Well, now all of a sudden, there's a mortgage commitment that you sign. And then it gets presented to the borrower. There's also a full disclosure that you have to be aware of, and it outlines things like the possible risks. It outlines exactly all the money that is laid out that the borrower has to pay. And now all of a sudden, your lawyer is dealing with you, and the borrower's lawyer has their own lawyer. I never touch the money. That money is sitting in your bank account until your lawyer puts it over and it's on the mortgage. And as soon as all that's done, the paperwork you'll get from your lawyer after very clearly shows the charge, that it shows that you are now the mortgage holder.
All right. Well, that sounds a lot more safe than pooling funds and just distributing them out, and that sounds great.
Oh, yeah.
What about the fact that, yes, I'm going to invest my $100,000 with you. I come to you and say, Sue, I'm ready to do this. You know, when a good deal comes my way, I'm ready to go. What would you say the average wait time is for investors, or private money lenders, while they're waiting for these deals to come up?
Okay, that can vary. And I'll tell you right off the bat, if somebody is going to do it through me, first thing I have to do is have a very in-depth conversation with them to make sure I understand what they need, that they understand the risks. It's a long, we have to go through that. Plus, they have to fill out my lender profile. It's only a one-page document, but it helps me to understand. And I'll use you as the example that you're, say, one of my lenders. I'm taking notes that you, in my file, I know all the ins and outs, the things that you're concerned about. Or for instance, let's say you go, yeah, I want to lend, but I'll only lend in the GTA. Okay, fair enough. I write that down. Or I only want to lend on second mortgages. Okay, fair enough. I write that down. So that then when I have a mortgage, I'm presenting it to you. And
that's amazing. Yeah,
so I know each and every one of my lenders. It's not a case, this isn't cookie.
It's like know your clients.
Yes, I have to know my
form.
Yeah, and I mean these are all rules too. That's why you also want to do this through a licensed mortgage professional, because I'm mandated through FSCO to do these things, and it protects you as a lender. It protects me. And of course the person borrowing, it protects them too, because then when they are given, I actually recently had somebody say to me, I can't believe in the end I borrowed all this money and then they didn't tell me about all these fees that were involved. And I'm thinking, how did that happen? Because either they weren't listening,
or you have to disclose that.
Yes, I have to disclose it. There's very specific documents that have to go back and forth for a lender as well as a borrower when you work with a licensed professional. And that's what, now, having said that, if let's say you do a bunch of them and now you're starting to get very comfortable with vetting them by yourself, by all means do it through somebody, directly. But I really would discourage that in the beginning, because I've seen horror stories and I'd hate you to be one of them.
I question how protected people are. So a lot of the problem that we have is a lot of people think at Real Property Investments that we're a fund or we're trying to get people's money and buy real estate and invest, and that's not the truth. We're all about the education and empowering people about their options to show people like, hey, have you ever heard about investing in private lending? Okay, well, if you want to do so, these are some things that you might want to consider. And even if it's private lending or private market products or any of these types of products, we always make sure we're dealing with licensed professionals as well. And these licensed professionals are independent. Normally they're not, but they are monitored by a regulatory body. They have something to lose. They have to adhere to specific rules and regulations, but they're not out there peddling their products for you, like the salesy, insurance people or the mutual funds representatives or stocks or anything like that.
Well, and I mean, it's funny, like when you're saying this, I have to also bring up, because I've had the question come at me a few times, and it took me by surprise. So I'll say it now in case there is somebody listening. They'll probably go, well, how does Sue make money? Well, just so you understand, as a mortgage professional, when I broker the deal, meaning when I put a lender in place with a borrower, I get a broker fee, but it does not come from the lender. And that's something I'll step into the next thing for people to understand. As a lender of your own money, so let's say you have $100,000 you want to lend. That money is put into a mortgage. So if I say to you, okay, this is a first mortgage, you'll get an 8% interest rate. It's an annual interest rate. You're paid monthly. You'll get a 1% lender fee at the very beginning. That's your money. You don't owe me anything out of the money you make. I make a broker fee from the borrower by putting the two of you together. Okay. The other thing that the borrower has to pay is your legals. Because you both have to have your own lawyer, but the lender does not pay for their own lawyer. The borrower pays for that. The borrower also has to pay for an appraisal. The borrower also has to pay my fee, the lender fee, and the interest rate. So is it cheap to get a private mortgage? Absolutely not. But it's very necessary. That's another whole topic, right?
Yeah. And then our returns are obviously good. Can we look into a number slide and see what kind of what a real deal looks like and what we can expect in regards to returns?
Okay. Now, here's just an example I put down. So let's just use on a first mortgage, a common one that comes my way, mainly because I do network with other investors on a regular basis. We have people that are purchasing. They're going to do a reno, and they're either going to flip it or they'll refinance it, okay? But to buy a property that needs a lot of work, the banks don't want to touch them. And of course, in today's lending market, the banks are not lending to self-employed can't get bank loans easily, the work. So they're going, oh my gosh, where do I turn? And they turn to a private lender like myself. So when I say myself, I'm on behalf of the lenders in my portfolio. I'm looking through of who's got what money to lend at any given time. Okay, so now they come along. So a common scenario would be 8%. A first mortgage can actually be anywhere from say 7% to 10%, and second mortgages are normally between 10% and say even as high as 15%. Can they both be higher? Sure they can, but those are going to be situations. I don't know if you remember the slide earlier, that rate is totally related to risk. So if somebody's going to be offered, I hear people bragging, they go, whoa, are you kidding? I got 18% on my last one. And I'm thinking, yes, and I'd like to see the deal that you were in, because it's probably very risky.
The higher the... Yeah. And as you become a more sophisticated investor, the security starts becoming more important than interest rates.
Yeah, I mean, because really, you want to sleep
your
at
options.
Yeah. So, and that's why, so I mean, the numbers I'm using are the ones that I work with, but there are definitely ones out there. You can get much higher and so forth, but you better be prepared that it's a higher risk.
Now, anyway, I was wondering if you could explain one more thing to the viewers really quickly here. So you mentioned that the first mortgage rate is between, what did you say, sorry, 8 and 10%?
Usually between 7 and 10%.
7 and 10%. And then the second is higher. It's between 10 and 15. Can you explain why the difference between the two, because people might not know, and why, how the process goes, and why you'd be given more interest for a second than you would for a first?
Okay. Now, first off, just again, from my perspective, whether it's a first or a second, I still won't go higher than 80% the value. Maybe 85 in some cases, but generally speaking, 80. So what it would mean, so let's say somebody has a first mortgage on their house. They now need a second mortgage because they want to consolidate some of their debt so that when they go back to refinance, they'll qualify. That's a common reason for doing that. The reason it's higher is because if all of a sudden now that person stops paying, the person who's in second position is actually at a higher risk, because first mortgage would get paid out first, then the second.
Mm-hmm.
The other thing that happens and stops paying both those mortgages, if the second mortgage holder wants to get paid, they have to keep up the first
Mm-hmm.
mortgage. Okay, so now you've got that to worry about. You can ultimately take over the property or you sell it.
Well, let's break this down to even more simpler terms. Let's pretend my house, I'm here at my house, and my house is worth $100,000. Let's pretend. I wish.
Okay.
Well, no, I don't wish, but I wish that was my mortgage. Okay, I have $100,000. It's like the total value of my home. I have a first mortgage of $80,000. And I went to Cuba and racked up all this debt. And I'm like, Susan, I want to pay off $20,000. My total value is worth 100. I have a first mortgage of 80. If you were to give me 20,000, first of all, that would be 100% value.
I wouldn't be doing it.
So you'd be like, no, I can't.
No.
I can only give you
Maximum 80% loan to value. Yes.
Okay.
So take that same scenario. Let's say your first mortgage is at 60%.
Mm-hmm.
I'm analyzing. That's why when people come to me first, I'm analyzing and going, okay, well, there's still 20% there. I could help you with that. We could give you a second mortgage on that, but we won't go any higher.
Okay.
Okay.
So I get my loan.
Yeah.
A little bit of security there. And then I did not learn from my mistake. I can't believe it. I went not to Cuba again, but now I went off to Mexico. And I racked up even more debt. And now I realize I have problems. I have a nervous breakdown. And I stopped paying my first mortgage completely. What happens at that point?
Okay.
So you have
So
to keep making up those payments so you can step in and get the second mortgage?
yes, I mean, it could at that point. Now, the other thing to keep in mind, that is another reason why we only do loans for 1 year at a time. Because for someone to get in really bad trouble in 1 year, that doesn't happen the same as if you've dragged it out for 5. Okay, so most loans are only going to be for a year at a time. Now, it doesn't mean that you couldn't ask for a renewal after, but the whole scenario would be checked out again. So let's say, use your example, all of a sudden I went, well, wait a minute, I'm not going to renew. Look what you've done. You're back into major debt again. Like, you've really shown your true colors that you don't know how to take care of your money. And so we could be saying, because there was no renewal in your contract, we could be saying, no, we want to be paid out. So if that's the case, if you might turn around and try and find another lender out there, but it won't be through me, because I'm very solid with the parameters on behalf of my lenders. And
well,
so
this is why I stayed away from private lending too for so long. Because I've got a lot of people trying to vet opportunities and get us to grow our money with them and promote it to our investors and all this sort of stuff. And often, if I am paying 12%, getting 12% return, what is the poor sap paying on the other end of this thing? Because who on God's green earth can afford to keep up with 20% payments or whatever it is on a long-term basis? And I know this might
that's why
out there, but
and that's why
people out there in the industry and they're not looking out for these poor people. Like sometimes these people, they're better off just selling their house or moving on with their business or even declaring bankruptcy rather than perpetuating this cycle of craziness.
And that's exactly
crossing their fingers and hoping that they're going to win lotto or something and this whole thing. Well, so I like the fact that you have this 1 year and you're analyzing the situation as well of, okay, so this investor here that we're going to loan money to is a flipper, and it makes sense because they've done it 20 times before and they've shown their thing. Rather than this is some shopaholic who's shown no signs of fixing their behavior, and the chances are like they have no job change. Like, I'm sure if I came to you and said, look, we had a medical emergency with our kid, it racked up $20,000 of debt, and now I'm just rebuilding our credit, and I have a new job lined up. Here's a letter. It's with the hospital, which was a 30% pay increase. You're like, wow, here's someone with a solution and with some real things, which in turn increases the safety for the
loan. Well, that's why, I mean, there's many things in looking at, but the 3 key ones, if people just keep this in mind. Number 1, the story, which you just said. So you just said the story there. Then the property, and that's the marketability again, right? And the third thing is what is the actual exit strategy? And there has to be a good one. And for the person that to do with where they needed it to pay off debt and so forth, they had better be working with a mortgage broker that's going to be refinancing them at X length of time. So there has to be a for sure game plan. And like you say, yeah, this is not something that that is just, I got the money and now, yeah, they can go off and do their thing. No, they have to have a game plan to be able to pay it back. So, and that's why I say people have no idea how many of these scenarios I'm on the phone and vetting them and then turning them down.
Yeah.
Because no, they don't. And I tell them right off, I have told numerous people, I really feel for your situation, but honestly, my best suggestion is you should sell your house now. Because
yes, because sometimes it's true. They have to sell.
Yeah.
And
they're
you're
going to be
helping
in the same
people.
position and worse.
Absolutely. I don't like people who take advantage of people's situations and they go back. So let's move backwards. Let's pretend so as a first lender, then what you're saying, that's the second, that's the process. So as a first lender, I'm getting a less return because I have more security. Once again, I am the first person in line. If this person misses this payment, the silent possession could start happening. And I know that I'm going to pretty much be first in line. I don't have to put my hand out to CIBC and wait for the remnants of the second, really. I am ready to go to recoup our investment for sure.
Yeah.
Excellent. No, these sound like two great options. Now, it sounds like you're kind of reminding me, and we vet a lot of opportunities. How many of these sort of opportunities come across your desk every day that you're sifting through?
I'm seeing sometimes 2 or 3 a day, sometimes 2 or 3 a week. Like things like right now, it's funny. I've had in the last few days 4 second mortgages come through, whereas prior to this, in the last few weeks, it's been mainly first mortgages. So it's like things come in waves. I personally love lending on both. I mean, I love the rates of a second mortgage, but as long as it still fits all the boxes to make me feel secure. And so here's an example. Like, so when you say, I have one right now that it's an investor. She just called me last night that she has one rental property that they're renovating, but she has equity in another rental property. And she says, how much can you lend me on it? So first question I asked her, what do you think that property's worth? She said she thinks it's worth about $260,000. I said, okay. And of course, we'd have to verify that with an appraisal.
They always get the appraisal, and you get to pick the appraiser.
I pick the appraiser, yes, and it has to be one that we are happy with how they do them, and they have to be a certified appraiser. But then I said, so what's your first mortgage? She says the first mortgage is, I think she said $135. So then I did quick numbers. She technically, no, it was $250 we agreed at. So she technically, to bring it up to 80%, that would make it that she could have a loan to equal $200,000. So without paying out the first mortgage, she could actually take out a $65,000 second mortgage. I said, would that be enough to do what you're trying to do on your other property for the rental? She goes, oh yes, it absolutely would be. I said, well then now we're talking, we have a scenario that we can start building on. Okay, we left it there. She's gonna, get back to me. But let's say it moves forward. The next thing that might happen if somebody wasn't happy with that particular property, because remember I said it's the story, the property, the exit strategy. Then maybe we would say, well, you know what? Let's use your personal residence as added security. See, there's times, so I'm looking at all that, and because my head's I'm listening to the borrower, but my head's thinking about the lender, what they're going to want to make them feel secure, because the whole goal is we never want this to go to power sale. We just want it, money's lent, money's given back. And everybody's happy.
On that particular example, would she have repaired that property and then went in for a refinance basically shortly after? Do you ever do your due diligence on kind of your quick numbers assessment on their ability even to be refinanced after, like assess the likelihood of them being able to be refinanced?
I was in the beginning, and that's where I found I was trying to wear too many hats.
Mm-hmm.
So now what I do, because right now I'm with the brokerage I'm with is Streetwise Mortgages with Dahlia Barsuam. As many people must know her, she's awesome to work with investors.
Mm-hmm.
So what I do is if there's anything to do with whether it's refinance or whether it be to assess your entire portfolio of what you want to do, I suggest I do an introduction that she works with them. And
right.
all I'm focusing on is a private mortgage. So, and it's funny you bring that up because very often I get people calling me, especially investors, who just assume that they cannot get a regular mortgage. We start going through their stuff and it doesn't take much for me to go, you know what? I said, have you already made sure that you can't go to the bank? They go, well, I didn't think I could. I said, no, before we carry on, I do not want anyone taking out a private loan when they can still get their finances through the bank, and then we back up and I pull Dahlia in.
Yes, I love that. You're kind of a team because you're assessing this person, you're like, whatever, okay. And you know a lot about people, like it's not that hard to vet someone's thing. So say if you're like, okay, so you want to do this on this property, that totally makes sense. And like, you know, I have here that like you're a teacher and you've been employed by the school board for 10 years and your husband's, I don't know, a gardener and he's been employed by, I don't know, a garden store for 50 years or whatever. You kind of have all this stuff there. You kind of know, okay, so they make like 100,000. This should be no problem. And you can see all their financials there. It should be fine. If you ever had any like, if you ever like, would Dahlia even kind of do a once over to be like, yeah, look at these people that are planning on having this refied after. Yeah, it shouldn't be a problem type thing.
Yeah.
And kind of secures the safety for the investor even more so.
Well, that's the exit strategy. That's the exit. Yeah. Because, but now let's take that same scenario and go, whoa, okay, I can get you the money, but if I cannot see a very clear exit strategy, we don't start the process, because what good is it to lend you this money at this very high rates and fees and everything, and you haven't got a clue how it's supposed to get paid back? That's not appropriate on my part, nor is it appropriate on a borrower's part to even try and do that. So
exactly. Okay, well that's great. I mean, this looks like a very, very easy, no effort way for people to grow their money and get a lot more than you're getting in GICs or stocks or mutual funds or any of that sort. Is there anything else you wanted to share before we hop off? Or
just one other thing, because I know we barely touched on it, and it's registered funds.
Oh,
and I'll tell you why.
I knew we were missing something.
Because as investors, I mean, we're both like we know it for years, and I still do it. I still have my own portfolio of stuff, and I still buy properties. But when you think of it, if your money's being tied up in that, that's great. But in the meantime, if you have RSPs, you want to look at now, can you do it, make more money doing it through mortgages versus the way you're doing it right now? I challenge you on that, because I'm 99% sure in most cases you can do better with mortgages. The other one is TFSA money, and I don't think the average person really recognizes the beauty of it. Think about it. Oh, well, I actually did try to put on my screen an example of somebody's statement, but it wasn't coming up very clear. But I'll tell you about it. This is somebody who has just come on board with me with their TFSA money. They only have at this point $44,000, but she has other funds, so I was able to work with her on it.
So do you mean she has other funds? So can you mix RSP, TFSA, LIRAs, and RIPs together?
You can't mix them, but I can use them all in the same mortgage. So from my point of view, then it brings it up that, yes, so let's say you had 60,000 of RSP and had 40 of LIRA, I can work with you. You basically have registered and then there's cash. Yeah, so cash is king. But the TFSA money, why it's important, so this person, her accountant had said to her 2 years ago, she had a lump sum from a sale of a property. He goes, until you know what you're doing with it, put it in a TFSA, and that's all he said. But she didn't investigate it further. She went to her bank, and at the statement's TD, and said, I need to open a TFSA. Nobody educated her. Do you know what they did? They put it into a TFSA, in cash position, and for 2 years, she has been making a little over 1% a month. So
Yeah.
when I looked at her statement, because I needed her statement in order to help her take that money, you don't take it out when you're going to do it, but she had to move it over to a trust company. You see on the bottom of the screen, the 3 different trust companies.
Yes, we
The
like
one
the one on the top.
I like Olympia Trust just because I've worked
That's
with them
our
for
favorite.
years. Yeah, but I mean, I will work with the other 2 as well. So what we did, and she goes, I don't know what I'm doing. I said, don't worry, I'm going to walk you through all of it. That's my thing that I'll do with all my lenders, is walk them through it, because I know it's confusing in the beginning. So we moved her money over, but in the meantime, that statement still makes me so angry. So for 2 years, she was making like $30 a month of interest, and it showed it on there. Now let's take that same money. If she lent out, what did we figure out? Let's say it was $40,000 at 8%. That'd be $3,200 she would make in a year. Divide that by 12. Like, the difference of lending money on a mortgage versus what's happening through the banks. It's yeah. So anyway,
we had a whole webinar on Olympia Trust.
Oh,
and
now,
everyone, we're always advising our clients. I can see some of them on here now, even watching. You know, open up your Olympia Trust account, and they're like, oh, but you know, is it going to cost me anything? Or I'm like, yes, $150. Does it mean I'm invested in something? No, it's a holding account, and a lot of it is transfer, and then you are ready to deploy. And also another reason you don't have on this list here are group funds, which I guess can be classified as a LIRA. So Vaughn, when he worked at his company for years and years, he had a group fund, and they did a matching program, which was great, free money. And when he left, he had a lot of money to transfer over. So we opened up Olympia, and we left them, much to their dismay. And they actually, quote unquote, said to us, I hope you know something about investments. And we're like, well, we're learning, you know, a couple things. But yeah, when we managed to actually move that group fund over, you can't leave when you're with your company, but if people are.
That's why it becomes a LIRA then.
They can transfer to LIRA, and then, hold that with the Olympia Trust as well.
Yeah. So, and now RIF, people go, what's a RIF? Well, anybody that's 71 and over, automatically their RSPs had to turn into a RIF, and now they have to take a certain amount out each month according to what income they're at. Well, guess what? It doesn't mean you can't still keep investing your RIF money. Like, keep building it. So, I mean, these are the avenues. There's also the RESP. I don't advocate them as much. They're more difficult to set up because depending on kids. But if we're going to, it's through Olympia Trust. I
also heard CompuShare.
I won't deal with it. No, unless somebody was, for me, unless they were willing to put it into Olympia Trust, I won't deal with them. It's just.
They're a bit, CompuShare could be a bit sticky, but you do that for the RESP. But I love that. And I love this knowledge about the RIF. Too many people are not looking up for our retired people out there. You know,
it's like, I mean,
you have to pull that amount and their tax on it. You know, there must be a strategy where they can get that and then live off a portion and reinvest, because our Canadians retirees, a lot of them are running out of money.
Yeah, and there's no need to not keep, but for TFSAs, the reason I'm so stuck on, like I have somebody right now, she has cash she wants to invest. And I said, do you have a TFSA? She goes, oh, no. Do you have an RSP? Oh, no. It's like, okay. I said, and so when I talked to her about at least a TFSA, I said, do you realize at this moment in time, you want to invest cash with me? That's great. But any cash you invest in anything, you have to claim it as active income.
Yeah.
Whereas if you did it, so for a husband and wife, each person can put maximum right now $63,500 into their TFSA. And you could be lending that out. You figure it out what your money is going to be worth 10 years from now. If you top it up each year and not being taxed. And the beauty too that a lot of people don't know. So let's say next year I want to buy a property and I need some money right now for a down payment. I could literally go into my TFSA as long as it's in a cash position at that moment in time. I could take it out, I could use it for whatever, and I say to people, only use it for investments so that you can then, once you're done with it, put it right back into your TFSA, and you can carry on without skipping a beat, and you don't get penalized for it.
Yes, like people need TFSAs. Okay, so we're all about long-term savings and all that stuff. Retirement plans, yeah, it's great. Maybe you want to have one open. But if you have to choose, a lot of people are on the fence between TFSAs and retirement plans. You should have one open. There's nothing hurting it, even if it's self-directed, Olympia Trust. But TFSA can be a lot more beneficial than a lot of people aren't even doing retirement. They're only doing the TFSA. But this comes down to conversations that you have to have with your accountant as well. But TFSA,
but it's knowing how to do it. So and that's what I'm using. Yeah, and that's what I'm using. My friend, what she did, she had it in a TFSA for 2 years, but she did not realize that all that the TD Bank did for her was open a cash account. Nobody explained to her about investing it from there. So guess what? Here's the TD. They've been using her money for 2 years. She was making $30 some odd a month on interest. And she could have been making over $300 and $400 a month on interest.
Meanwhile, they're probably loaning her money out and investing in private.
Absolutely. So
that's
again,
too.
Education's key. So anyway, I'm sure we're at the end of our time now, but I did want to at least touch on.
No, this was important because if you don't have the cash, you might have it on paper and registered funds, TFSA, Leras, RIPs, or you could have a mix. So for everyone out there watching and wanting to be a lazy investor like me and grow their money passively, how can people contact you?
Oh, yes. I guess I have to move forward to my, oh, shoot. What did I do? Sorry, there I am. Okay. So as you said at the beginning, I'm the founder of Private Money for Mortgages, but I'm with the brokerage that I work through is Streetwise Mortgages. And there's my name, my phone number, my email address, go to my website. I'm totally about questions. Don't hesitate. Pick up the phone if you have a question or send me an email. I'm on Facebook.
Reach out to Sue and grow your money. I love it. Everyone's going to get a replay of this. There's a bunch of people that didn't log on. Unfortunately, the people that were on are a bit too shy to ask their questions.
That's okay.
But hey, if you're shy, it's okay. We work with shy people. Just send Sue an email. We are all very easily found. Google her, research her. You know, we're not going to find any bad
Just don't stalk me.
Yeah, you have a crush on her. You kind of draw the line there. But feel free to do your research, do your Google, get in touch. We're all contactable on social media. And Sue, it was a pleasure. You are such a smart, savvy investor. We're so lucky to be growing our money with you and working with you. And you come out to all of our investment clubs. And it's always such a fun pleasure to see you and your smiley face and your knowledge and passion about mortgages.
All right. Well, thank you. I really appreciated you bringing me on the webinar today. So,
Excellent. Well, it's always a pleasure. And thank you to everyone who has logged on. And we have a message here. Finally, Brenda says, this was great. Thanks, ladies. Thank you, Brenda. I'm so glad that you enjoyed it. And we have a question. You late bloomers. Oh, my goodness. Pam, I see you out there. She wants to know, I'm sorry, Susan, we always do answer questions. Even if it goes,
that's fine.
We're for the people. She wants to know, can you transfer funds from RRSP to top up TFSA to maximum amount and then invest in private mortgages?
Unfortunately, I don't believe you can. Now, that would be a question I would ask Olympia Trust directly, but you can't, because when it's in an RSP, if you take it out, now you're taxed on it. See, it went in there tax-free. But a TFSA is with after-tax dollars. So you can't just move them over. But you know what? To be sure, don't take my word for it. I would call Olympia Trust and ask them that question. But I don't believe you can.
And I'm 99.999% sure you're right.
They're two different products. And another thing, just to remind people, please, if this interests you to want to put money into mortgages, please do not take the money out of your registered funds. I had somebody do that once, and it was like, they go, well, you told me to. I was like, no, I'm saying you can transfer it. Yeah, please do not take it out. Yeah, because then you're going to deregister them, and you will get dinged. You'll pay 30% right off the bat.
That is correct, and it's important for all of you guys to know that, have licensed professionals or ourselves to tell you this and bring awareness to these issues. So it doesn't look like there's any more questions, but thanks, Pam, for your question. That was very good. We love questions. And thanks, everyone, for logging on. We are going to see you next Thursday at 12 p.m. Eastern Standard Time for our next lunchtime webinar. Thanks, everyone.
All right. Thanks.